Subprime mortgages, the liquidity crisis, asset-backed securities, the discount rate. For a lot of people, the only real question is, what do I do with my portfolio right now, if anything? So today's task force has some answers. Joining me now, DiNuzzo, president of DiNuzzo Investment Advisors in Pittsburgh, and Kathy Pareto, partner and senior financial advisor at Investor Relations in Miami. And of course, Alan Murray rejoins me, assistant managing editor of the Wall Street Journal. Nice to have you all here. Kathy, let me start with you. What are you hearing from your clients? Are they worried? Are they changing their asset allocation at all?
Well, I think that everybody's rather worried. We're doing a lot of hand-holding at this time, and I think that now is when investment managers are in their keep, so to speak. And so we're fielding a few calls from clients who are a little nervous, but we're telling them to hang in there and don't run for the exits. PJ, what are you hearing?
Yes, we're talking with clients. There's a little bit more hand-holding that goes on at this point in time, but really a lot of folks have gotten lulled into a little bit of a false sense of reality, and that the volatility had been much lower since coming out of 2003. But really, it's just pretty much business as usual. Market's just picking back up and just doing what it normally does. Pretty much standard.
So let me ask both of you. Traders can make money off of volatile markets. Institutions can make money off of volatile markets. But what do your clients do when they're faced with markets that are going up and down 300 points in a single day?
What our clients are faced with is really matching up the time horizon with their portfolio. So really the short-term volatility doesn't bother us quite as much. We're looking at 20, 30 plus year time horizons. Really, we're keyed up about a 65-35 asset allocation, and that's really what drives it for us.
Kathy?
And I would concur with that same statement. A lot of people think that going to cash right now is a sound thing to do, and in fact, it's a mistake to do that. If you miss out on the first 5-10 days of a market upswing, and they come fast and they're unpredictable, you've missed out on a huge percentage of potential growth for the rest of the year and the rest of your investment program. So, essentially, we're staying put. We're telling clients, look, we've got a reasonable strategy for you. We've looked at all these issues in advance. We've gauged your risk tolerance to the best we can. Now's the time to stay put.
So it's kind of close your eyes and don't look for 6 months.
You know what I tell my clients when they call, and I say, just don't open your statements for this quarter, maybe the next one.
Probably a good idea. PJ, what about your clients who still have a home mortgage, who maybe have a home equity line of credit out there? Are they at all worried about what's happening in the mortgage area? Are they worried about the value of their home? Because that can be, in some cases, the largest asset that someone has.
Really, our clients aren't expressing any anxiety over that topic because they've got a good mortgage in place. Most of those they're on schedule to pay it down. Everything is really in good order, so there's really not any anxiety being shown by our clients in that area.
Kathy, what about you?
Agreed. Our clients are usually affluent individuals, and that's not even a concern. Subprime is not even their territory, and most of our clients are in that house for the long haul.
Mm-hmm.
But what do you tell them when they try and figure out how much of my assets should be in that house and how much of it should be in the market? What's the better investment right now? Is it real estate or is it the stock market?
Kathy, why don't you go first?
Well, I'll tell you, mortgage rates are still rather cheap. If we look at the 70s, for instance, 6.5% is not a bad deal. And so if you think that over time, say the next 10, 20, 30 years, you can do better in the market, then direct that money to the liquid markets, not your house. Your house, I see, it's kind of a separate asset class or component of your net worth.
PJ, what about, are you hearing from any of your clients that they want to get in now, that they feel, we're trying to get a gauge of, because nobody on Wall Street knows certainly, where we are in this event, this market event. Are you hearing that they think that the worst is over and they're willing to commit new cash to this market yet?
Yeah, I had a couple conversations earlier today. I had a couple of clients who were talking about they thought this was a great opportunity to potentially put some extra cash that they had available to work. Mm-hmm. But we are instructing our clients that we do feel that, this is typical. We're going to see this type of volatility, maybe a little bit more even for the next few months to come.
Kathy, what are you hearing from your clients? Anybody willing to put their toe in the water?
Oh, sure. I've had actually a couple of clients who are more defensive in, say, a 60-40 or 70-30 split say, I want to go all equities now. Now is a buying opportunity when there's blood in the streets. And while I don't really condone tactical asset allocation, if that's what they want to do, then not certainly I'll endorse it if it's appropriate for the client.
Fascinating. Thanks very much, both of you. PJ, Kathy, thanks a million. And Alan will be back in just a little bit with us again.